Damian, I'm going to start this episode of the Skadi Podcast with a massive shout out to friend of the show, Antoine Marmotin, who posted yesterday tagging me, I guess, in his post about the recent rogue trading incident which has taken place at Macquarie involving commodities.
It has, yeah. Announced yesterday. This was the 26th of November.
Yeah.
And it is on their, metals and bulk, or bulks, in fact, to be correct.
Metals and bulk trading and freight trading. And these are trades which were undertaken by Travis Lloyd Klein, not to be mistaken for the husband of Jocelyn Wildenstein, the wonderful woman who's had the most amazing plastic surgery, or not, if you ask her. She's had none done. But anyway, I'll let you will be the judge when you Google that name on the website and go to the various Daily Mail articles about her. She's fantastic clickbait. But anyway, we're kind of digressing from this. But Antoine, I think, has made, really caught this story quick, because actually, although the final notice was published 18th of November, it only really hit the tapes yesterday. That's when the FCA have released details about this. And Antoine has immediately focused on a number of interesting points. But for us, we've certainly done 4 episodes I can think of on road trading, because we looked at the SocGen recent incident in Asia.
Yes. On
our Rogue Delta 1 episode.
Yep, and going back further in time, we've looked at the sort of the 3 biggies, I suppose you'd call them, the Leeson, Kerviel, Adeboli, which actually in this training that we delivered to the London Fraud Forum, amongst other places. So yes, I think it was such an interesting story that we felt it was time we should sit down pretty quickly and discuss it. So I think it's
what is fantastic about this episode is it's going to refocus everyone's attention, because it's been done in commodities. It's also, I think, the first incident really of any gravity that's come out of the COVID period, because this trading took place through COVID, and there are some key learning points, I think, from that, which is not actually, I don't think that's brought out in the FCA notice at all, but that's certainly our thoughts.
No, absolutely. We sort of, we've all tried to forget it, I suppose, a lot of the lockdowns and how strange it was. But yes, this is, this activity started from June 2020. And if you think we'd been in lockdown for a bit, obviously, having just said
March it was.
March is the big sell-off. If you remember, that's that real equity, real sort of smackdown where you saw the S&P drop, whatever it was, I don't know, I'll get the numbers wrong, 10, 15%, and then rebound. But that was, so your vol is definitely on the increase.
Yeah.
And yes, so I suppose we ought to set the scene slightly. I'm sure.
Yeah, let's row back and let's just tell everyone what happened. So why don't you talk everyone through what occurred? What is this incident
Yes,
about?
So this is about a trader at Macquarie, a pretty junior trader actually, who was creating fictitious trades, having basically been told in June 2020 to get his book down under the report that's been released by the FCA. It sort of turns out that he felt he was going to move the market a lot by trying to get his book down. So rather than doing that, he started to create these fictitious trades. And I think there were a total of 426 fictitious trades that were booked over the course of quite a while, actually nearly 2 years, that attempted to, in a way, show that his position size, the delta of his book had come down. When this was discovered by Macquarie, they've actually taken about a $58 million US dollar loss on it, and have been fined 13 million sterling by the FCA for lax controls. And we'll get into what they've suggested have been the reasons why he's looked to get around these controls and how he's got around these controls.
Yeah, and that's exactly right. So I think this is really interesting as well from the point of view of how the control functions, and in particular operations and product control, acted as enablers really for his activity. And Antoine actually talks about this and talks about, was there, some sort of, social engineering going on that he was able to, persuade people. But I think there's a couple of key things to understand here. And this is really specific, I think, also, or a heightened risk in commodities. There's two things. As we well know, you've done a lot of work on commodities. You've been out to Rotterdam in the last couple of years. You've been working on stuff for banks in London as well. Commodities have, by their nature, quite short settlement cycles, or can do.
Yep.
Particularly in the futures market. And then the other aspect, particularly when you're trading within a bank, is the delivery risk.
Yep.
So if any of this, pushes beyond, just the trading in and out of these contracts, and you actually get to a situation where you've missed something, you haven't closed off the position, and you've got the delivery risk.
Yeah.
And there's a change. And just those things by their nature mean that, certainly from an operations point of view, if we think about them first of all before looking at product control, if you're in operations, and this goes to the culture of operations, which is something that David Bridges has spoken a lot about, who is Skadi's ops expert, is the fact that you're under so much time pressure.
Yeah.
So this idea that you're going to challenge everything, actually, you really just want to clear the decks, get everything settled, get everything moving. So when you're presented with a load of breaks, your culture is to try and resolve those, to get these things clear, to inquire, why it's happening, yes, but really to get things, fixed so that they move on.
Correct. Yeah.
And that's a big thing about, what happened, I think, in this story, because there's a phenomenal amount of cancel and corrects in this story. And as an individual, he was responsible for some, a vast proportion of the desk's cancel and corrects.
Yes, yeah, I think they've worked out something like 70% of them. But as if you look in the final notice, there are two final notices: one to him, the individual, and one to Macquarie. And in the Macquarie one, they talk about the fact that a lot of these would have appeared in a spreadsheet, but the spreadsheet was thousands of lines long, and a lot of them might have been flagged as auto. Not an issue, as it were. So to actually dig through and see that data, it was very hard to pick that data out from those thousands of lines. So it's that classic whereby the data is being created, but then not summarized correctly, or not being able to. Well,
data is noise until you start to really manipulate that data effectively. We've had examples ourselves. I mean, we did an investigation a few years ago where there were some trades, and a review team did look at those transactions and just concluded that there was nothing to see, and they hadn't cleaned that data at all. And if you just looked at that spread of data, all you could see was a load of transactions. But when you actually went into that data and started to sort those transactions by time and sales, then a pattern emerged of a series of spread trades. And that tells a very different story to an investigations team than simply some set of random trades. So yes, the reporting internally within Macquarie definitely seems to have been weak, if not problematic, for their cancel, corrects and amends, which is a big part of the story. And I can't believe in 2024 we're still talking about cancel and corrects.
Yeah, it does seem.
I mean, that's as old as the hills.
Yeah.
The idea that you can go in, cancel trades, amend trades, push out settlement dates to avoid
pushing out settlement dates is definitely so apparently with their systems just wouldn't pick up any trades that were sort of outside the norm. And I assume, as most of these were futures, in the T+1, anything that was booked T2, T3, T4 was just dropped off the chart. So incredible.
Yeah.
Right?
So again, and it's about prioritizing the workload for the ops team. They've got so much that they're trying to deal with, and they're trying to deal with the urgent bargains first, because that's where the problems are going to arise. So in the case of this situation, as you say, he got into a situation where he was losing money for the firm, and there was a decision to bench him, in inverted commas.
Yeah.
And that's an interesting concept, and something that actually I've come across myself some quite, I would say, eyebrow-raising types of what's the word really? Almost employment really of people in the commodities area, because again, the commodities business is different from other businesses inside of institutions. So, equity markets have a market open, market close. Fixed income as well. There's, hours aligned to the traded markets. Commodities definitely a global business, and some of those businesses within commodities are 24-hour a day markets. You think about power and gas.
Yeah, I was about to say, yeah. They're balanced all the way throughout the day, 24 hours, absolutely.
Yeah, and we encountered ourselves, many years ago, a bank was employing, contractors. And again, this sounds quite benign, like contractors. These were like sort of hired guns coming in, to do the night shift or whatever. That's not what was happening, in that case. In that case, these were very, very junior people left unsupervised. But if they, evidenced some real ability, then there was that carrot, that incentivization that they could find themselves permanently employed on the desk. Now, this is an example of, I'd say, a disincentivization.
Yeah, I would say the reverse in a way, yeah.
Yeah, so here at Macquarie, you have people being benched. It's a real sort of, football talk or whatever.
Yeah.
You don't perform, you don't time out. And I think that, the regulator has been quite down on, incentivization, thinking about the crisis and the fallout of the crisis. The way people were paid was definitely, frowned upon. The regulator spent some time trying to remove that kind of, or, dial down that incentivization. And it's certainly an interesting thing for the UK now, with Rachel Reeves kind of rowing that back and saying, hey, it's okay. We can let everyone get paid as much as they like. That's incentivization.
Yep.
These things are going to come back in. And I think that's one, almost a sort of cautionary tale in two parts. One, if you're sitting there in front office controls, let alone audit compliance, but thinking about how incentivization may come back into the business and whether that's being done correctly and what are the ramifications for that, but also identifying, in fact, disincentivization, because we're very good at focusing on where people are being incentivized, but not necessarily where they're being hit with sticks, and it can have just as much effect. And in the case for this chap, for him, the kind of the fear, I think, of producing big losses, unwinding this book, has potentially, and I'm giving him a lot of mitigation here. I don't know the guy.
Obviously,
it's not but it's driven him to start trying to work out ways of getting his risk down optically, without actually getting his risk down, for fear, as you say, of pressuring the market and therefore making big losses. Right?
Yeah, or maybe, well, obviously we don't know the full details. So maybe his feeling was, look, I've got a really good. I mean, we've all been there to a degree. You sort of fall in love with a position possibly, and you're like, well, actually, I don't want to take this off because I think this is the completely the wrong time to cut it. So if I can optically show I've cut it, but actually run it, and I could look an absolute hero and get absolutely looked after.
But it's very hard to kind of pull out that, I didn't cut it, look. I still made it. I was right. You were wrong, management. I don't know about that. But well, you and I have definitely worked with people who've been very resistant to cutting their positions over time. I don't think you and I have been guilty of that. I think we've been quite...
I think you're asked to cut a position. You cut your position.
I've been quite thankful.
Quite, yeah.
No. But... That is, it is definitely something to think about. And what I think is interesting in respect of this individual, Mr. Klein, is that he was trading the derivatives. He wasn't trading the underlying.
Yeah.
His focus...
I think it's mostly freight. It doesn't. It seems to imply that it's basically freight forwards.
Well, but as you and I know, with derivatives, there are models, there are inputs, there are ways that you can alter your risk appearance by altering the inputs to those models. And I think that's something that people should really think about. This is a wake-up call for people. This individual did not do this. We understand. He's, entered into fictitious trading. But I think if he'd have been a bit more knowledgeable, a bit more experienced, and we've tried to find out more information on him, and we can't at this point, but just interested in kind of his background. If he'd have had a bit more knowledge, then it's absolutely possible, and for other traders out there, for them to change the appearance of their risk by messing around with
inputs
into their models. Yeah. And that's, I think, something that, again, front office controls should be thinking about, market risk management should be thinking about. When we're seeing exposure reduction on the risk report, what is the evidence behind that? Is that happening because physically the amount of contracts are diminishing?
Yes.
Or
the contracts, there's no change in contract numbers.
There are no change.
But my risk has collapsed.
My risk has gone down significantly because, in a terrible market, my credit's tightened. I don't think so. So there are some checks there. But of course, if you're looking after so many businesses, so many traders, have you thought about that? Or are you just simply getting out your risk reporting in time for the next cycle of risk reporting to start? And that's, again, take 5. Have a look, a little bit of forward thinking about what you're producing and the value of that. And are there some small changes you could make as a result of what you're learning here out of this instance that could make that reporting more effective? Also, what management information is being produced about any changes that are being made by people to not just, transactions, but actually the very instruments that you're modeling and that you're trading in.
Yeah.
So I think that's sort of, important considerations there. He was clever enough, and this comes out loud and clear in the report, to alter the pricing fraudulently on some of the curves.
Yeah. So just taking one step back, the report highlights 3 avoidance methods he uses. One of them is being able to manipulate the end-of-day futures reconciliation. The second was then being able to manipulate the daily P&L reconciliation. And the third, as you say, was much more to do with IPV, independent price verification. And that was a failing from Macquarie's point of view, in that risk were taking traders' word for screen prints or for broker quotes to get inputs into their system for their marking. Whereas obviously most policies would say that the risk department themselves should be, even if they're not reaching out to a broker necessarily to get a quote, but they are at least verifying that a quote they have been sent by a trader is what was sent to them by the broker.
Yeah, and for finance to do this, obviously they should be going direct to the pricing source. Mm-hmm. But again, there should be an understanding of what is the provenance of that particular price, because actually, the chance of you being fed back your own price as an institution by a broker is definitely a risk.
Yep.
And if anyone wants to understand, the symbiosis between traders and interdealer brokers, just go back to episode 40 of the Skadi podcast on interdealer broking, which is not about actually independent price verification, but again, is just about the control that is exerted between a trader and an interdealer broker, and how much interdealer brokers need traders and how much traders can need interdealer brokers. There is so much symbiosis there that actually, the possibility and the probability that some of the pricing that you're sourcing from an IDB is not very independent, is quite suspect. It is a risk.
Yeah.
So other pricing sources, probably better, actually.
Or rotating through your pricing sources. So you're not, for instance, just reliant on broker X. We get that report and that's all we use all year round to be our, in inverted commas, third-party check.
Yeah. So that was certainly, an area, but also the very fact that when he was presented with pricing curves, he would then go in and make his own changes to those curves before presenting them to finance for their IPV. And that's, that to me is kind of interesting, because going again back to the point about input data, he was clever enough to realize that if you're pricing something from a curve, you can play around with points on the curve to, yield the kind of price appreciations you need to generate the profit for you on your positions. So I think if this activity wasn't uncovered further down the line, I think he could have got smarter, actually.
Yeah.
And that's really interesting. But one thing that you have raised and we haven't really talked about, and I think this is an important moment to really focus in on this. This activity was during lockdown.
Yep.
And we've talked a lot about the amount of lines on the risk report. We've talked about the number of trades and so on. We know that during lockdown, people moved all of their computing away from the office into the home. The connections, at least initially, were not as robust.
Yeah.
Things had to get robust pretty quick.
I think, on the fly reports were generated rather than that sort of full, okay, this is, quite often these reports can take quite a while to generate. So, and you sort of forget all this, but yeah, absolutely in lockdown, people, you wanted just to, you wanted to know what your risk was, but you wanted, quick, easy reports. You might sort of cut a few corners here and there just to make sure that you could just keep on top of what your risk was. Because also remember, volatility's gone through the roof as well. So you really do need to be on top of this stuff. So yeah, absolutely. We sort of forget all that as we sit here now.
And I think that is a good wake-up call for people to think about if there are any aspects of, again, I'm pretty shocked in November 2024 that we would be saying this. But you know what? If you don't say these things, it never gets checked. So if there were changes made during COVID from an operational point of view to make things easier, to make things work, have you reviewed and rolled back those changes back into business as usual where we are now? We have had investigations where, around, sharing of non-public information, controls were, it's considered, because people were out of the office, there was much more of a stronger kind of, delineation between information, that kind of stuff, information barriers. Well, now we're all back in the office. And have you therefore changed the way you're operating to reflect that return to the way we're operating and made the controls as they were pre-pandemic?
Well, and that comes up in this case as well. So there's a remote booking angle, and the sort of famous case from that way back when, or not, well, way back-ish when, was mirror trading, which was people booking, across books, across jurisdictions. But that was seen in this case as well. Now, that may well have been a sort of pandemic thing, as in people were like, listen, we just got to give people, we've got to get stuff moving, we've got to make sure everything's booked, et cetera, et cetera. We might allow access to other books just to help facilitate that. But as you say, you've got to ensure that has been rolled back as we've moved through time post that, and to return to work.
Well, I think you raised a really interesting point there about the remote booking, because that's something that could have come about by that. I could buy that. I could buy it's a COVID related thing. I think it could be something else. I mean, if you think back to the work that we did around, remote booking and, reviewing that for audit and compliance, it was in the years following the discovery of the Deutsche Mirror Trading scandal. And that was a period when the banks actually had kind of moved out of commodities.
Yeah.
And it's possible, and you know what it's like, right? You're going through and trying to make a risk judgment on where are the areas of risk. And I can see it being the case that banks probably were very focused, and brokerage businesses very focused on the kind of instruments affected by the mirror trading scandal. So looking at, depository receipts,
yes, dual listings, etc.
And that kind of work. Thinking, right, we can't have remote booking around this stuff, but then also make a connection going, well, we should also just think about, FX, we should think about fixed income. But many of the banks at this time will have possibly, not had a commodities area.
Yep.
And then that commodities area has reopened. And do you know what? Some of this remote booking practices have been allowed because people haven't really thought that this business is just the same, exposed to the same risk.
Well, and also,
businesses.
as you alluded to earlier, some of these are 24-hour markets. So you might need almost, the risk might be booked on the New York book or the London book during those hours, but actually someone might need access to be able to book a hedge against something in New York, in London time or whatever it may be. So absolutely.
Yeah.
Commodities, they're a different instrument to a degree from that perspective.
That's a really interesting point that I hadn't thought of, Damian. You're absolutely right. Sort of other things that we've thought about here is and you posed a question actually when we were talking about this morning. Where was surveillance in all of this?
Well, right? Given that these are listed products, I've traded futures before, not freight futures. I'll hasten to add. These things have to trade within the spread, and you would assume. Well, we don't know. Obviously, was he booking stuff outside a spread or whatever it may be? But trade surveillance should be picking these trades up, and they were obviously slipping through somehow because they were appearing as breaks at the end of the day, but there was nothing from what we can see that they were being picked up throughout the day, and that's what trade surveillance should be doing. Every trade that goes through should be being mapped against where the market stands to see if it is within the spread, whatever it may be. It's interesting. There doesn't seem to be any particular mention of trade surveillance within this because it feels like that was definitely a failing.
And as you've seen from your own work, firsthand, you have these LEIs, these kind of local.
Yeah, this is a post-MiFID.
Legal.
Legal LEIs, legal legal entity identifier. So I'll get there in the end. Which whereby any entity trading on any product across any listed market, that a LEI is attached to that trade because it allows you then to strip back to look at every single print that you made. For instance, if you get a fill, if you're a big hedge fund trading in equity and you're trading, I don't know, hundreds of thousands of shares over a day, you can actually request every single print that occurred under your name throughout the day to look at TCA transaction cost analysis to be able to allow you to be able to dig down to see how the trader was trading as the market moved for you. So these LEIs are quite useful identifiers to allow this to happen. And obviously, if you're trading a future on any exchange, be it freight or whatever, there should be an LEI attached to that. Now, maybe it was Macquarie's own internal LEI, but none of these trades were appearing on the exchange, because they were just being internally, created and then possibly destroyed.
That is a point, isn't it? In the Macquarie final notice, as opposed to Mr. Klein's final notice, they do make reference to, the internal counterparty. And people therefore just not worrying about it, internal counterparty. And you saw that in Curviel, you saw that in Adebolia as well. Well, yeah. All the greats, all the greats, DT.
Yeah.
So actually, this and it, again on Antoine's post, the original, just going back to the original post that kind of tipped us the wink on this one. He and Dan Barnes made the connection, immediately between, the activity at SocGen and what this looks like. And that really does raise the question about lessons learned, doesn't it? But I think, one thing, as I sort of sit here and listen to what we've been talking about and talking to you, I kind of want to roll this all back to Rogue Trader Stew just quickly. And I know we've been going on for a little while, but I think this is sort of, a bit of fun. This is the Skadi training. So we broke down Rogue Trading into the kind of key ingredients, core ingredients for control functions to look at. Now, so ingredient number 1, the corrupt individual. Well, he's Rogue Trader, duh. So I think we don't need to worry about the corrupt individual and the fact that he faked the prices on the curves and so on and made up his own stuff. Definitely a corrupt individual. Management vacuum. management vacuum. We're in COVID.
Yeah, exactly.
We've got people sitting at home, and that goes to the other point, business in transition. I mean, COVID was a massive transition event, right? So we're already ticking the boxes on the first 3 core ingredients. Next, I haven't read enough into it to be able to say, but the key ingredient from the other, from the big boys was the suppressed account.
Yeah.
And I don't know about suppressed reporting. I don't think we've seen any suppressed reporting in this instance, have we?
No, not that I'm aware of. No, certainly.
I mean, what you do have is you have operations actually telling him how to book trades to avoid the reporting. So in that respect,
as long as you don't book him T+1, you'll be fine, because they just won't even appear on the exception.
So that is a bit of suppressed, suppressed account or suppressed reporting. So I'm going to give that a half tick for that one. Now this is the big one: lack of operational challenge.
Yeah,
that's been the case on every rogue trading episode that we've looked at, and on this one, I mean it's incredible, and the fact that he was able to, be enabled by them, get help from them, like the things you're talking about. Move, just settle these a little bit later so they're not hitting the report. I mean, I think, absolutely.
And if you read it, there was quite a lot of one-on-one chats with a junior person within ops, and then an asking to resend the whole group email to everyone, having been sort of, in inverted commas, cleaned. So that's exactly as you were saying. Well, the operational side.
And that's something that Anton focused on, actually, that kind of social engineering, if you want to call it that. But definitely, if it's always a risk, right, between front office staff, operational staff, and the fact that it's so hard to break down that symbiosis and that desire, one, to help, obviously, because they, ops want to help, but also there is a pathway. Ops want to be getting to that seat, some of them, many of them, in the front office. And so to be someone that helps and,
a friendly face, useful.
Exactly. And it can be good. And also, junior person on the team being dealt with directly by the trader, that's kind of, whoa, yeah, it's nice. I'm in there with these guys.
Yeah,
that's all good. Liquid instruments, what's your view on that one?
Not really in this case.
Well, I think also on this case, this is a $54 million, I think it was, hit. We're really talking about the big boys here.
Yeah.
They're all the $1 billion club of Nicolas and Jerome Kerviel, $6.9 billion for him, I think, and Kweku Adeboli. They are significant sizes for them. So there we go. Here's an interesting question, which I've seen nothing about: mandatory time away avoidance. Because again, for the big boys, They were running schemes so big they couldn't take their mandatory time away.
Yeah.
I haven't seen anything about this, but this guy, you have to question. I mean, he's managed to carry this on for nearly 2 years. There's some mandatory time away in there. What happened?
Yeah,
that's a question I'd love to know the answer to. Don't think we're going to maybe find out the answer. If anyone from Macquarie is listening and would like to come on the podcast. And here's a massive one. Know your cutoffs: daily, monthly, quarterly, annually. Well, I mean, he was all over this, and it was revealed to him too. And not just the timing cutoffs that we've talked about there. There's some really important P&L reporting thresholds in terms of values that he got wind of.
Yeah.
And then as soon as he knew those, he kept his transactions below that level. And so you've really got to ask yourself the question, how do you keep all those confidential? Do you change them?
Yeah, exactly. Do you move them around a bit?
Move them around?
Just tweak them now and again.
I mean, you're a big proponent of looking at volatility and asking yourself the question, are these levels, risk limits, whatever, fit for the market you're in? Well, the same with your cutoffs. Why are you putting a cutoff at 50,000? How volatile is the market?
Yeah.
How big are people going to get? What's a significant trade at this point? But that's a real key one. And another one that we don't know the answer to, but the other ones we're all exposed to: operational experience.
Yes. From what we've read, I don't think he's had an ops background. He started in Sydney and then moved to London pretty quickly after that. So, but you could have been on the graduate program in Sydney, might have dinged around a few desks, get a feel for how ops works, how compliance works, whatever it may be. Pre moving to London, we don't really know.
Yeah, and Travis, if you are listening and you would like to give your side of events and tell us about how your rotation through the graduate program went and all the different places you work, we'd love to have you on the Skadi podcast. Yeah, but I don't think that's going to happen. But there is an open invitation there at any time. And then the final one for the biggies, to which this is instant discovery, fraudulently producing a customer. I don't think he did that, did he?
No. From what we've seen, no. I think it was all, it was just trades that were backing against nothing. So there was I don't think there's any customer booking there. I mean, he was dealing on Macquarie's behalf on their own account, plus doing some client facilitation. But there's no call within what we've read that there was anything against clients.
Yeah. So that's a quick, real review of the situation. I'm just trying to think if there's any further lessons in there.
Well, I suppose one I'd slightly bring up was circling right back to the beginning when you were talking about how commodities is T1. Well, we're starting to see the world moving T1 in a lot of other products. We've seen the US move to equity T+1, and Europe has now, I think, given a date. I'm going to get the month wrong. Sometime in 2027, October, I think. Possibly. Anyway, 2027 to move to T+1. And as you say, that moving and as we've talked about before in some of our research. And it's been shown that moving from T2 to T1, the window shrinks massively. It's not suddenly...
it's not a 24-hour reduction.
Well, and it's certainly not a halving, because in fact, you're compressed into sort of 3 hours. You've got to get things matched.
Yeah.
And that's just pressure on ops. That's pressure on settlements. That's which is possibly can possibly lead to errors, or just we're just trying to force things through. Without due consideration.
Well, it's that cultural conduct point. Is how is behaviour in ops going to be affected by the move to T1? How has it been affected by the move to T1? That's an interesting cultural audit. I wonder if people are undertaking. I think they should.
Yeah,
because I think there's some serious lessons. And then to cross-reference, how is the challenge in ops different where they have more time, in your organization? That would be an interesting exercise.
Yeah.
So I think there's definitely, things that people can be, looking about. But I think that's a really, really good point to raise there, Damian. So if you've enjoyed this episode on road trading, as I say, there are others on the Skadi podcast. We've mentioned episode 40, which focuses on the Rogue Delta One incident in Asia. I think it was earlier this year.
Yeah, this year.
And if you go way back to episodes 15, 16, and 17, you've got the Road Trader Chronicles on the Skadi podcast, and that deals with the 3 large episodes. And now we have this one, which I think is very, very timely, coming into year end, for people to think about, the impact on their things. There is actually one last thing that I wanted to talk about, which was on Mr. Klein's final notice, and they calculated, how much he should be fined. The entire fine was waived for financial hardship. And I have to say that kind of raised my eyebrows, not from a financial hardship point of view, but just the fact that actually there is no financial sanction on this individual who was in a high-paying job for 2 years undertaking this activity. Admittedly, he's barred from taking up other roles again. But I just found, I don't know, I wonder what your perspective might be on that.
Odd, in a way, well, yeah, I think I raised eyebrows as well. I mean, if you look, I think Kerviel was told to pay back something ridiculous like 4 billion, which he sort of was like, okay, that's not really good. But, it's odd that there isn't, for instance, well, okay, I understand there's financial hardship at the moment, but, you owe back 50 grand, and that may be, pay a bit like a student loan as and when you can. But it's to be zero seems odd, I have to say.
It is interesting. I mean, you and I worked with a young graduate who later then went on to another institution. I'm talking about Jonathan Bunn here with the Lewis Charles situation, where his rogue trading episode was only over £3 million, and he was jailed for a couple of years. Now, the difference there is that transaction did bring the firm to its knees and resulted in a lot of people getting made redundant, scaling back and stuff. I think maybe that's the difference here, because I think the point was made that these were fictitious trades that didn't affect external customers.
Exactly. No effect on the market or to clients. And I suppose maybe that's the mitigating factor.
Yeah. Interesting one. All right, Dan. Well, that was our kind of Skadi podcast, road trading on the fly, looking at the Macquarie road trading incident. I would love to have feedback from people and their thoughts on this, because I think it really raises some interesting points. So do get in touch. Otherwise, do search out Antoine Marmiton's post, a great post about this. It's really sparking the conversation. He raises some really good points in his too. And we look forward to having you back with us on the Skadi podcast. Got some interesting episodes coming up, haven't we?
A couple of interesting ones lining up. So.
We've got, I think, a catastrophe bonds one lining up as well. I think Alexandra's just doing the editing on that one. We had Bobby Banerjee in helping us on that one. Leading on that one.
It was a great chat. Actually.
It was a fantastic job. Really interesting, and talking about the parametric bonds there as well. So really looking forward to that. So if anyone's listening from Lloyd's, we've got a really tasty one for you coming up on that one in the next, probably next few days even. Yeah. Anyway, that's been the Skadi podcast. Thanks for listening. Happy Thanksgiving to everyone in the States, which I think is tomorrow. And happy belated birthday to me, Damian. It's my birthday yesterday.
Happy birthday, Nick.
Exactly. And you all forgot.
Oh, man.
All right. Thanks a lot for listening. Bye.
Bye.
You've been listening to the Skadi Podcast, featuring Nic, Corry and Damian Taylor. This podcast is produced by me, Alexandra Mexi. If you found today's episode interesting, you want to be a friend of the show and interact with like-minded people, you should join the Skadi Discord. Our chat community is a big treasure trove of information where you can find all the materials we use to produce our podcasts. If you want to listen to more episodes, then simply search the Skadi Podcast on any streaming platform. Feel free to connect with us at Skadi Limited on LinkedIn to read about our research and business relation to anti-financial crime and control functions. Until next time, thank you for listening.